Coming up in today's show, stocks finished the day lower after a Fed governor says interest rate cuts shouldn't be rushed, sending bond yields higher, along with the dollar, what happened in the Taiwan election, AMD rips higher on a new price target, and cannabis stocks rip on details of the recommendation by the Department of Health and Human Services. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. Thanks very much for joining me today, and we're off to a bit of a soft start in this shortened trading week on Wall Street. After the long weekend in which markets were shut yesterday to observe the Martin Luther King Jr. holiday, and it was quite bearish across the board, led down by energy, oil and gas stocks. Only real big stock that held up was NVDA and AMD ripping up over 8%, which I'll get into a bit later on. And just looking at the S&P 500 daily, we're acting a little soft here in this all-time high resistance zone. Still a stone's throw away from all-time highs at 48.18. Market seems to be struggling to push above that right here. We do have some bearish divergences happening on the chart. The Magnificent 7 actually found new highs today thanks to NVIDIA, which ripped up to all-time highs today, along with a strong rip in AMD, which is approaching its all-time highs. And just going out to the weekly chart on the S&P 500, we're currently testing those highs from late 21 before the market rolled over in 22. And just going to the equal weight S&P, we seem to have pulled back a bit from this resistance zone and a bit more so on the Russell 2000 small caps. Kind of pulled back a bit from this resistance zone, and we got a little bit of a pop today in the VIX, still pretty low by historical standards under 14, and we can see in volatility risk premium option dealers starting to increase their implied volatilities a little bit here. And so 2024 isn't off to a great start in the stock market. We may be lining up to get a bearish January trifecta because we've already got a negative Santa Claus Rally. We've got a slightly negative first 5 days of the month, and then if the whole month of January comes in negative for the January barometer indicator, looking back in history typically leads to soft results for the rest of the year. Last time we got it was in 2016. The full year did okay, ended up 9.5%. However, the time before that was 2008. We had a really bad year. Before that was 2005, up 3%. 2000 down 10%, and looking back even further, it can lead to some pretty soft results for the year. If we have negative Santa Claus Rally, first 5 days, and January finishes down as a whole, can result in softer than average results and kind of set the tone for the year. And just looking broadly across the global economy, we do have some soft manufacturing data out there, and that can typically correlate really well with the performance of cyclical versus defensive stocks, which is kind of like a risk barometer, if you will. Looking back in the GFC, cyclical stocks significantly underperformed defensive stocks, and we saw that in 2018 going into COVID as well. However, over the last year, we've had a pretty good outperformance of cyclical versus defensive, and now we've got a bit of a gap between the spread of those growth safe stocks versus the manufacturing index. And the last time we saw that bigger spread was actually back here in late 2007, before global stock markets fell over 50% into 2008 going into early 2009. So long story short, if cyclical stocks are to hold up this year, we really need to see an uptick in manufacturing, which would mean we'd really need to see an uptick coming out of China and the Eurozone as well. What does give us a bit of tailwind this year is that it's an election year, and looking back in history, election years typically perform well, especially with a president looking to stay in. They typically pull out all the stops. They do not want to see a recession or the stock market tumble. They're going to do a little bit more spending to shore up some votes. And since 1950, the average election year finishes up 7.3% on the S&P 500. However, if the previous year was up more than 10% like we saw last year, then that average gain goes to 10.5%. So typically the start of the year, we should see January perform well, and we get a little bit of softness going into mid-March, and then the rest of the year is pretty much straight up to the right. And looking back at last year, we got every single seasonality pattern to the T almost. However, contrasting that strong seasonality is another strong pattern. And that's the fact over the last 70 years, there's never been a post-inversion equity market rally that's using the 10-year, 1-year spread that has not been more than fully reversed going into a subsequent downturn or bear market. And so we're here in the red line, and we're probably around here right now. And that's pretty much been the historical best performing stock market rally since we went inverted on the 10-year, 1-year. And looking back in history, it's just been nothing but down, down, down. As pretty much every single time that's happened, we've got a recession and the stock market's bottomed after the recession. So that's the really interesting dynamic we'll be following closely on the Click Capital channel this year, is which one's going to win out. That election year seasonality, the hype around AI, analysts expecting earnings to bounce back and grow again, or will the inverted bond yield curve be right once more? And just looking at the popular bond yield curve spread of the 10-year minus the 2-year, we're actually climbing back to that break-even point. There's a long-term chart of that spread going back to the late 80s. And shaded in the grey here are recessions. And you can see every time the bond yield curve went inverted, once we went uninverted, a recession was just around the corner. And we saw that again in 2000, 2007, 2008, briefly in COVID. And here we are now with the biggest, deepest, longest inversion and on our way back to that neutral territory. So one's got to wonder, is this pattern going to repeat itself? And maybe later this year or early next year even, we could get that recession. And what causes the bond yield curve to go uninverted again is basically yields up the front, which are more sensitive to what the Fed does, like the 2-year here. It's been in a pretty steady downtrend since late October now, and that's kind of forecasting that the Fed's going to cut rates just in a couple of months from now. Then the 10-year is always looking out more further ahead, being a long-dated asset, and that had already been predicting the recession by being a lot lower than the 2-year. However, that's holding up a bit better now, because now that's starting to look past the recession and for growth to eventually come back to the US economy if and after we come out of a recession. However, once again, we've got another mixed signal out there in the form of the price action in high yield corporate bonds, typically sensitive to risk and the thought of potential defaults on bonds, which we see in the junk issuers in recessions. Not really worried at all. Still uptrending above the 50-day VWAP, even though I've got TLT just losing its 50-day today. Also interesting, we've got inflation expectations as measured by the spread between inflation protected treasuries versus regular treasuries popping up above its 50-day today, in a sign the market may be changing its mind a bit on how aggressive the Fed is going to cut. And is inflation really going down to 2% this year? However, analysts are still expecting S&P 500 companies' earnings to hold up, which is a big driver of the stock market. As of today, we're still very early in Q4 season. Year-over-year earnings decline, basically flat. However, they're expecting the index to come in with 4% growth in Q4. And we just heard from the banks starting last Friday, which came in a little mixed. And we just heard from Goldman Sachs today, which came in a lot better than expected, reporting a 51% surge in fourth quarter profit. And that was a bit of a bounce after they had 8 quarters of declines. And the gains weren't from investment banking and trading, it was from asset and wealth management. However, once again, a mixed picture because we got another of Wall Street's biggest banks, Morgan Stanley, seeing its quarterly profits slide as its investment banking income sinks as well. And that was their fourth quarter profit falling by almost a third. As like the other big banks, they had a variety of one-time charges. And just looking at the price action of Morgan Stanley there, pretty big fall today, down 4%. And even Goldman Sachs with that good result couldn't hold more than 1% gain today. And so there's quite a wide disparity between what Wall Street banks are forecasting this year in both the economy and the S&P 500. We've got price targets from 3,800 all the way up to 5,400. And Goldman Sachs sees much stronger economic growth in the consensus. They don't see any recession this year, and they're even estimating GDP to be double what the street is expecting. We've even got some research out of Bank of America saying we're in a secular bull market, and that could last through 2033. Pointing to prior secular bull markets from 1950 to 1966, 1980 to 2000, then using that as a roadmap to chart the current rally, with them saying the current secular bull market officially started in April 2013. So they're saying we're only in the 11th year, and history suggests a long runway from here. So it's no surprise we're seeing a Yale sentiment gauge showing individual investors are feeling the most optimistic about stocks in nearly 17 years. That's largely on the back of anticipation that the Fed is going to cut interest rates. However, like some people are saying, big rate cuts and an economic soft landing are unlikely to go together. Then we've got Fed Governor Christopher Waller saying, hold on for a second, not so fast. Interest rate cuts shouldn't be rushed. We're not quite where we want to be on inflation. He did say they need to be cautious to avoid over-tightening. However, at the end of the day, the Fed's just like the rest of us. They're going to be looking at the data and trying to guess what happens in the future is very hard. They don't have the best track record. And so they're just walking the line of wanting to prevent a resurgence in inflation, as well as not holding rates too high for too long, sending the economy into a bad recession, especially going into an election. It's a very delicate time. However, if we were to keep seeing a bit of an uptick in CPI and inflation, the market might quickly come around to the fact that maybe the Fed is not going to cut in March like they're currently forecasting, and that could upset things quite a bit, and that's what could give us a good 10-15% correction in the stock market in this quarter if the Fed indicates they're not going to cut in March, because we've got some surprise CPI numbers come out. And we did see a bit of a reaction in Treasury yields today after those comments from the Fed governor. So we really need to see some inflation data staying on the downtrend in order for markets to not get really worried here. Also not helping risk assets is a bit of a pop-up in the dollar, which can correlate with Treasury yields. And that could be a bit of a flight to safety with what's going on around the world as well. And so watch the dollar for clues on the stock market, because the stock market really wants to see a lower dollar. And that helps a lot of companies that export as well. Another troubling sign is the Empire State Gauge, sinking to the lowest level since the pandemic. That's New York Fed's Business Conditions Index going deep into contraction territory at 43.7. Anything below 50 is contracting. And so like I showed you at the start of this video, world manufacturing still on a downturn. There had been some signs of a bit of a resurgence with America and other Western companies looking to reshore manufacturing. However, that still has a long ways to go. Let's not forget about the ever-present risk in CRE, commercial real estate. We saw office loans hit 6.5% delinquency rate in the fourth quarter, as there's still a lot of bad debt out there that just simply can't be serviced because there's just no tenants to pay it. And let's not forget there's estimated 4.6 trillion in outstanding commercial real estate debt. So that's nothing to sneeze at all either. What could really change the narrative in the markets is if we see a material pop-up in oil. And just like Chevron CEO Michael Wirth said, it's a very serious situation and seems to be getting worse with what's happening over there in the Red Sea. We've now got the Western Alliance led by the States attacking targets all over the place and trying to cool things down and prevent it from spilling over. But so far, oil hasn't really popped up. Even Chevron CEO said he was surprised US crude oil was trading below 73 a barrel. That's thanks largely to the huge amount of supply coming out of the States and other non-OPEC countries, and still soft demand around the globe. We've even seen major oil company Shell suspending Red Sea shipments, and this is thanks to the Houthi militants, which are another group backed by Iran, repeatedly attacking commercial vessels in the Red Sea in response to Israel's war in Gaza. But it would be surprising to see the Houthis win this in the end, especially since the States and other Western allies are striking back on them as I speak. And so the Biden administration really doesn't want to see oil pop back up above $90 a barrel. It's going to upset the American consumer, inflation, the whole narrative going into the election. And so I'd say they'd squash this pretty good. However, Iran may see that as a window of opportunity to throw a curveball in an election year. And so they probably will keep instructing their militant group subsidiaries to keep attacking, try and keep the pressure on. And there's a look at the daily of crude oil futures, still hovering around the $72 a barrel, kind of coiling up here in sideways action. If it wasn't for what's going on in the Middle East, I'd say we'd be testing these high 60s again with all the oversupply. However, there's still a tail risk here. We could pop back up above 80 if we see continued shutdown in shipping routes and more flare-ups in conflicts over there. And just looking at some global politics and other geopolitical tensions, we've had Taiwan have their national election over the weekend, and it was the pro-democracy, pro-Taiwan independence Democratic Progressive Party hold power once again for an unprecedented third term, and greatly upsetting Beijing as they see him as a separatist. They really want to pull Taiwan back under the umbrella of China. However, Taiwan's people have come to like democracy, a bit surprising I know, and they're aligning themselves more and more with the West, much to China's dismay. And so that's going to keep US-China relations a bit on edge, and we've even seen Secretary of State Anthony Blinken said China's increasingly aggressive strategy towards Taiwan goes against its own interests, with China pushing back and saying the states are gravely wrong to congratulate the new leader. And why we follow global politics here on Click Capital is because governments are the biggest drivers in markets. They do have material effects for what happens out there, with one of the biggest being in the semiconductor industry. As Taiwan's biggest company, the Taiwan Semiconductor Manufacturing, still the largest chip producer in the world, and up until recently, the West has greatly relied on them. However, that's what's caused the new CHIPS Act and a strong political will to bring chip production back to the States. And that's what's been a good tailwind for the likes of Intel last year, and of course the big ones, NVDA and AMD. And so Xi Jinping has said they are definitely going to take back Taiwan at some point, period. Nobody knows when. It was looking like he pulled back. However, it could still be a window of opportunity going into a presidential election. Maybe they see the States as not wanting to start a war right then, whilst they're also busy in the Middle East and Ukraine. A lot of voters aren't liking sending billions and billions of their tax money and labor offshore when there's a lot of problems at the southern border. And so either way, this is upsetting for China, and they could make a move on Taiwan, maybe just going into the presidential election while the states might be a bit preoccupied with domestic issues. We'll just have to wait and see. However, if that were to happen, gold would be a good place to be, and probably the semiconductors like Intel, NVIDIA and AMD, as the state's really going to have to rely on their own domestic producers. Just switching gears a little bit and moving on to Bitcoin. After last week's big moment in the industry, when the cryptocurrency, long hailed for its decentralization, finally became centralized by Wall Street. Now they've got their hands wrapped around it and will be custodian for millions of investors' digital coins. And this will be one of the big stories we follow this year. to see how these products unfold. There's a look at the iShares Bitcoin Trust from BlackRock. Just printing its third daily candle. Hasn't been off to a great start. Market initially opened, ripped up to $30 a unit. Here we are 3 days later, almost getting down 20% from that high. And just looking at a spread of the iShares Bitcoin Trust versus the underlying Bitcoin itself, it's already underperforming. Or it may be in a case that it opened up way too high. And just looking at Bitcoin itself, after we had that pullback the day after they launched, and we're just currently sitting at the 50-day here. Market's kind of undecided what it wants to do next and just coiling up a little bit. Ethereum though is holding up a bit better, still hovering near those multi-month highs. Got a huge rip in AMD today, thanks to Barclays lifting its price target by a huge $80 a share, raising it to $200, suggesting a 37% upside. That's on the back of more growth they see coming for AI chips. And like I said, with what's going on in Taiwan, that just provides a further tailwind for the American chip producers. And we can see that in that strong bullish price action we got today. AMD put in a huge 112 million shares, finishing up 8.3%. Just taking it out to a monthly chart, it is approaching those all-time highs of $164 a share it put back in November 21. Staying on the monthly chart, there's NVDA, breaking out to all-time highs today, above 560. And so no doubt Nancy Pelosi, along with her husband who loaded up on NVIDIA calls back here, must be quite pleased with what's going on, and she's probably foreseen what's going on with regulations in Taiwan as well, and so she's positioned her wealth accordingly. We also got some details of the documents from the Department of Health and Human Services recommending the Drug Enforcement Agency DEA to reschedule cannabis from Schedule 1, which is in the same category as heroin, to a much softer Schedule 3, which should pave the way for further federal legalization. That sent cannabis stocks ripping across the board. However, we're still waiting on the DEA to reschedule, which they're widely expected to do any week or month now. And there's a look at one of my picks for this year, the Cannabis ETF MSOS, breaking out to multi-month highs, up 6.4% today. Also finding new highs today was one of my other favorite assets for a while, and one of my picks this year, uranium. The squeeze is on. Uranium prices are hitting records. A lot of people in the industry saying things are just getting started here, with the spot price of uranium climbing to over $103 a pound. Yesterday, a level we haven't seen since 2007. That was after the huge 90% gain we had last year. And part of that rush back into yellow cake is hedging from utilities. They've kind of let the price get away from them a bit and are trying to catch up. And there's a look at the biggest uranium ETF, URA, breaking out to highs again today before finishing a little bit soft. Still in a well-defined medium-term uptrend. High highs, high lows. Assets looking good going into this year. Moving on to economic data we got out today. Inflation data from Canada coming in as expected, 3.4% year-over-year growth. A little bit of deflation month over month. There's the Empire State Manufacturing Index coming in a lot worse than expected. Got a bit of data coming out from China in a few hours. Looking out to tomorrow, got some inflation data coming out from the UK and Eurozone. Going on later into the day, looking at retail sales from the States. Thursday, we'll get housing data along with jobless claims, and not a whole lot to finish out the week. After those remarks from Christopher Waller today from the Fed Fund futures pulled back their probabilities. The Fed will cut. It was about 75% last week. Still looking like they're going to cut in March. About a 2/3 chance. However, that's still going to swing a bit, like I said, depending on some inflation data we get in. Stock market fear and greed index still cruising in the greed zone here. And corporate insiders really not interested in buying this market. However, they're not doing a whole lot of selling either. We do have a bit of a pullback going on underneath the hood in most stocks. We only got 39% of stocks in the S&P above the 20-day average, and we actually saw new lows on the Nasdaq outpace new highs today, and only 162 stocks and ETFs breaking out to new 52-week highs today. Almost matching that was 158 stocks and ETFs breaking down to new 52-week lows, with the biggest being Alibaba and the China large cap ETF. Still haven't found a bottom in the Chinese stock market yet. There's a look at the dollar. Popping up pretty strong there above the 50-day. Still got shipping rates holding up as well. Got a bit of a cold snap going on in the States at the moment. Natty gas market foresaw that. However, it's already pulling back. International stock markets a little soft and sideways to start the week off here. And we just got the spread of international developed stocks versus S&P 500 losing support, breaking down to new multi-year lows. Over to stock sectors, it was semiconductors, the real standout today, up 1.5% thanks to that upgrade from AMD. Apart from that, it was red across the board. Saw a bit of a dive in the gold miners, along with clean energy, which is super volatile, getting down to lows. And this is a really cheap sector in the market, offering up some good valuations. There's a look at my 2024 picks, pretty soft across the board except for cannabis. There's the Magnificent 7. Saw Apple fall today after a US Supreme Court turned down Apple's attempt to appeal a decision in an antitrust case over its App Store, a rejection that could create new options for companies such as Netflix and Spotify to sign up customers. Today's decision means companies' apps can now promote the option for customers to purchase subscriptions outside of Apple's App Store, potentially at a lower price, such as paying directly through their websites. So Apple's done a pretty good job holding an almost monopoly and charging developers 30%, which has upset a lot of people in the industry for a long time, which a lot of people refer to as kind of like an internet tax. And so it looks like the industry, who's been fighting back for a few years now, is starting to win that battle. However, it looks like investors bought the dip in this support zone around 180. And with Microsoft finding new highs today, it is now officially the largest stock in the world, 2.9 trillion. Just taking a look at Tesla there, looks like we may have found support around this 210 level. We are technically oversold, especially compared to the rest of the Mag 7. There's a look at Coinbase, the biggest crypto exchange in the States. Looks like it's been a bit of a buy the rumor, sell the news going into the launch of the ETFs last week. And it could be a case of, why do you need to buy Bitcoin through Coinbase and pay their huge spread and fees when you can just buy the BlackRock Bitcoin ETF and pay 0.25% with much lower third-party risk as well. There's a look at Alibaba. Stock I've been watching, I think, is at good valuation levels for the medium long term. Just lost $70 price level today. And even though this is super cheap relative to its sales and profits, with what's going on with China and Taiwan, it's likely to remain volatile to some time. However, I'd say if the Chinese economy and stock market takes another leg lower, we're going to see a huge stimulus bill coming out of Beijing to try and get underneath it. There's a look at Intel, which has been a beneficiary of the reshoring of chip production, one of the best performing S&P 500 stocks last year. And just looking at the big banks after they reported earnings on Friday, Bank of America, Citigroup and Wells Fargo, along with JP Morgan having a bit of a pullback here today, and so not the best price action coming out of them. And we've still got a few more to come with Charles Schwab tomorrow and the regional banks over the next week or so. Okay, so there we are, guys. Starting off the third trading week of 2024, market's kind of looking a little soft here. Do we have this big bearish divergence in the S&P 500? We could still push through these all-time highs. I'm keeping an eye on the volatility market for clues of that. We did get a bit of a pop here today. And like I said, we've got some soft breadth up the front. And I'll be keeping an eye on the volatility risk premium to see what option dealers are forecasting. But just looking at my sector trends table indicator, we've already got most sectors having a short-term pullback underneath the 5-day moving average. It's really just tech stocks and semiconductors holding up the best, and we've got quite a few underneath their 20 days already. So the market underneath the hood, not just looking at the S&P and NASDAQ, is already in the midst of a bit of a short-term pullback. It's really just the Mag 7, this chart here, holding up the big indices thanks to the likes of NVDA, which is ripping up, and that's why we've got the S&P 500 just kind of hovering below those all-time highs. But looking at the Russell 2000, that just closed underneath its 50-day VWAP for the first time in a few months today. So there's a bit of work to do underneath the hood for us to push up here. Otherwise, the S&P may peel away from these all-time highs as well. We may just get that negative January result, which will give us the bearish trifecta, which is not a good sign for this year. That's all I got for you today, guys. Thanks very much for tuning in to Click Capital and hitting that like button, and I'll see you again tomorrow night. Cheers.